What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody. I hope you're all doing well. Let's start, as always, with the economy. Yesterday, we did a deep dive into the critically important Central Economic Work Conference, which concluded over the weekend, an event that basically sets the tone for economic policy making in 2022. And I provided you guys with some of my initial thoughts on the event. Now, we have more information today, so we are going to engage in a more thorough analysis of China's economic plans for 2022 and what we should expect over the next 12 months. State media continues the steady drumbeat of stability. On Monday, in a special piece on the economy, state-run Xinhua media reported, quote, "In the context of increasing downward pressures, the Central Economic Work Conference reiterated that economic work next year should prioritize stability while pursuing progress. Multiple stabilizing measures will be adopted." The financial state-run Economic Information Daily expressed in a piece yesterday too, quote, "Stability will be the guiding principle of China's macroeconomic policy in 2022, experts told us, in remarks that reflect the downward economic pressure facing China." End quote. The piece also touched on deep concern about fading consumption in recent months. Quote, "Fiscal policies will have a larger part to play in 2022, with major policies focusing on public consumption and weak links in the economy." End quote. Top leadership in Beijing has demanded that officials, quote, "ensure stability on 6 fronts and maintain security in 6 areas." End quote. Okay, so what the hell does that mean? Well, ensuring stability on 6 fronts was introduced as a policy objective in 2018, and it refers to maintaining stability in employment, the financial sector, foreign trade, foreign investment, domestic investment, and economic confidence. Maintaining security in 6 areas is a newer concept that was first introduced last year, and it refers to maintaining security in jobs, basic living needs, operations of market entities, food and energy security, industrial and supply chains, and local level governance. In a nutshell, the consensus among international economists and analysts watching this event over the last few days seems to be that there will be no massive stimulus in 2022, but rather supportive policies only. However, even modest support measures to keep growth above 5% means that serious deleveraging cannot happen, and as such, debt will continue to rise faster than GDP for the foreseeable future. Meanwhile, a survey of economists by Bloomberg's investment unit published today found that economic activity in China likely slowed down in November due to the, quote, "worsening downturn in the property sector and subdued consumption," end quote. Growth in fixed asset investment probably weakened last month too, dragged down by, quote, "sluggish property investment," end quote. Now, the second point to explore from the Economic Work Conference is about capital markets. And this I find very interesting, particularly interesting, these comments about capital markets over the last few days and from this conference. We remember from China Update yesterday, the Central Economic Work Conference readout expressed, quote, "It is necessary to set up traffic lights for capital, strengthen effective supervision of capital according to the law, and prevent barbaric growth of capital," end quote. Now, aside from the use of the phrase barbaric growth, something that jumps out from this phrase that I just quoted for you guys is this traffic lights for capital. What exactly does this mean? Well, Han Wenxiu, Executive Deputy Director of the General Office of the Central Financial and Economic Affairs Commission, has provided some explanation as to what the government means when it talks about these traffic lights for capital. He adopts very Marxist language in his explanation, which should remind us all that there are still ideological Marxists in even the highest levels of the economic policy-making elite. This is what he expressed, quote, "How to make use of capital's positive role and restrain its negative role under the conditions of a socialist market economy is a novel challenge facing our party. The answer is not found in the classic works of Marxism-Leninism, nor in the experience of the planned economy of the Soviet Union. Capital is profit-seeking. It is necessary to strengthen effective supervision of capital according to the law, to prevent the barbaric growth of capital, and also to support and guide the standardized and healthy development of capital. Curbing the disorderly expansion of capital is not about not wanting capital, but rather about wanting the orderly development of capital." End quote. The point that he seems to be making here is that the government wants to give a red light, as it were, to the negative side of capital, e.g. speculation, instability, crashes, etc., and a green light to the positive side of capital. For example, healthy wealth creation, innovation, development, etc. Indeed, yesterday in a commentary, state-run Xinhua Express quotes, "To give the green light, we should give full play to the positive role of capital as an important factor of the production in the market economy." End quote. Now, the problem is that no economic system has ever successfully pulled this off. That is, enjoying all the benefits of essentially capitalism without any of the drawbacks. Though some socialist economies, communist economies in the 20th century did try, and with devastating results. This is what Han Wenxiu is getting at when he says that the answer is not found in the experience of the Soviet Union. And it was certainly not found during the Mao era either. Now, in saying all this, we are seeing a lot of Marxist analyses for key economic policies with this year's Central Economic Work Conference, more than we've seen in previous years. This is from page 1 of a major state-run paper, The Economic Daily, yesterday. Quote, "How to correctly understand and grasp the characteristics and behavior laws of capital is a brand new major theoretical and practical problem that must be faced and solved, and is related to the healthy development of a socialist market economy. The Central Economic Work Conference profoundly explained this, emphasizing dialectics and methodology." End quote. Yesterday we discussed a fresh COVID outbreak in Zhejiang province. Unlike the previous few months of cases, which have primarily been in the less economically important periphery of the northeast, Inner Mongolia, Gansu, and Yunnan, Zhejiang is a critical economic engine of the country, hugging Shanghai and at the heart of the Yangtze River Delta. With just over 100 cases in a few days, officials say that more than 500,000 people are now in centralized quarantine. Restrictions now affect tens of millions of people, with travel in and out of the province restricted until at least March next year, making travel home for Chinese New Year very difficult for tens of millions of migrant workers. State media today had articles about concerns on whether people will be able to return home to celebrate Spring Festival, with the state-run Global Times writing this morning, quote, "Some city governments in China had already released notices to encourage residents to stay where they are for the upcoming festival." End quote. At the very least, this outbreak will cause supply chain problems, and if it cannot be brought under control soon, tougher restrictions would likely have major economic impacts. Now, full disclosure, I actually live in this region, and some of the restrictions have affected me. I also cannot leave the city unless I provide a negative COVID test. Also, while we're on the subject, local health authorities are reporting that in the city of Tianjin, a major city about an hour high-speed rail from the capital, Beijing, in northern China, detected the Omicron variant of COVID-19 in a person who traveled from overseas. This is the first known official Omicron infection found in the Chinese mainland. The shares and bonds of Chinese property developers plunged in the market today after a deal between units of Shimao Group Holdings Limited heightened renewed concerns for investors with the Chinese property industry this week. In China Update yesterday, we discussed the sudden drop in the bonds of developer Shimao Group Holdings and how it sparked a broader sell-off in the market. Yesterday, Chinese junk bonds fell after Shimao's dollar bonds dropped as much as 10 cents on the dollar. Its Hong Kong listed shares dropped 12%. Today, things got worse. This morning, Shimao's shares collapsed by over 16%, their biggest daily drop ever. According to Bloomberg's investment unit, the firm's dollar and RMB bonds also tumbled, pulling down other Chinese high-yield notes with them. Today, analysts with US-based JP Morgan Chase expressed in a research note that a government acquisition announced by Shimao late Monday, quote, not only implies tight liquidity conditions for Shimao, but is also a corporate governance red flag, end quote. Shimao is China's 13th biggest property developer by sales and among the largest property debt issuers with about $10.1 billion in outstanding local and offshore bonds. Also today, China Evergrande Group's shares dropped to a new record low, dropping as much as 8.7%. This morning, Hong Kong time, crisis hit developer Fantasia Holdings Group in a statement expressed that it and its unit Fantasia Investment Holdings had not been taken over by creditors, denying reports from some media outlets that they had been. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.